Welcome everyone to this Market Thursday, February the 18th. It's 5 o'clock, I'm in London. So welcome to this new webinar. Quickly, as usual, I just want to start with a quick disclaimer, just to let you know and to remind you that those webinars are non-investment advice. This is mostly for information, meaning please do your own research before doing anything and putting any position. That is really something that is important. Don't take everything and literally do your own due diligence. A bit of my background. So I started in 2000 as a cash equity trader in Paris, working for a company called Pierre Charon Gestion, then DTAM. From 2004 to 2008, I worked as hedge fund manager, first on the long only product, then on a long short product, for a company called Griffin Capital Management. In 2009, from 2009 to 2018, I worked for a as a proprietary trader for Infinity Capital Markets, where I recently rejoined, where I have an absolute return mandate with no asset and returns constraint. On top of that, in 2014, I started doing some mentoring program for another company that I left in 2017. In 2018, I restarted my own mentoring program and launched in October 2019 the 4x4 video series. So before starting the usual stuff, I just have an announcement to make. So in the next few days, we will be launching the trading community. So that is something that I know is really important for most of my clients, both for the mentoring and the 4x4. So if you bought the 4x4 or if you have been doing the mentoring, you will get access to two different communities. So really the target is for us together to be sharing ideas, the process. So obviously this is not the size, this is not going to be a huge community. So we are talking roughly about 100 people if everyone joins. But the whole idea, again, I know that people were really, that is something that is important. And I know as well that many of you have been buying a lot of education where people have been telling you, oh, you're going to have access to a community. And actually years after years, this community never came out. So important for me, as I said before, that I wanted to do this community to deliver on this. So for all the mentees and the people that have done the 4x4, that is pretty exciting to get this product and working together, finding ideas and process. So that's hopefully going to be ready in the next week or so. Today, what are we going to be covering? So as usual, we're going to be starting with the situation across asset classes, around the 4 asset classes, looking at the recent performances. Then we will be looking at the passive investment and how the big inflows that we had at the end of January and February had a strong impact on the market. Then we will be looking at the ongoing earnings season, which can be summarized with bit and bit. So quickly, situation across asset classes. As usual, let's start with this chart where we'll be looking at the asset classes from stocks here to commodities. So the stocks, what has been, and that is as of yesterday. So far, the outlier has been the Russell 2000 and the emerging market. So the Russell 2000 has been outperforming the overall market. So it's trading around 2250 and it was at 1600 at the start of November. So we had roughly a 40% move. So it feels a bit overextended. So now it's coming from the highs of 4 or 5% because we needed a bit of a breather. But clearly the blue hand side on the left tells you that this is a risk on market and equities have been very, very strong. In terms of the currencies that we have in purple here, Bitcoin accepted, euro dollar has been moving sideways. So the dollar is moving versus most of the currencies in a 1 to 3% range. So on one hand, we get a lot of deficit that are probably coming, and on the other hand, we get the yields, especially the US 10 years, that is now breaking and going higher at 130% tonight, which is making the dollar more attractive in terms of carry trade. Bitcoin on a tier above 50,000, as I told you. I mean, I started to look at it and put this Bitcoin into the asset performance when it was at 1,400. So I haven't been completely wrong on this. In terms of commodities, the gold has been selling off. We are below the 1,800 now. WTI is above the $60. Which can explain by a restart of the economies and supply and demand, keeping in mind that the Saudis are just not putting all their production on stream. Again, there have been some talks now that they will increase their production probably from next month, and that might put some pressure on the WTI. In the meantime, what is happening in Texas these days, the last couple of days, means that 2 to 4 million of barrels are off. 2 to 4 million, that's between 2 to 4% of the world production. So that is why, as well, the WTI has been doing pretty well. If we look on a week-on-week, so normally I used to do weekly webinars. I'm a bit more busy with trading and portfolio management, and as well looking after my mentees. But overall, again, Bitcoin is the big winner. What is interesting is commodities have enjoyed a lot of volatility recently. For the indexes, for the last 5 days or so, we had a bit of consolidation. Now we are coming down a bit on all the indexes. That's something we're going to be checking when we look at the price action. Across the sectors now, for the S&P 500, looking at the 11 sectors. So energy is the big winner with the financials. Energy, obviously, because WTI went from 50 to 60, and for the financials, because yields are going up, there is a steepening of the yield curve, which is vastly favorable for the financials. On the other hand of the spectrum, we get utilities, by definitions, that are suffering from yields going up because of the size of their balance sheet. Consumer staples, as being defensive, has been struggling as well. But overall, we can see that even if it was as of yesterday, market S&P 500 is up 4 to 5% year to date. Now, if we look at the other asset classes, looking at the bonds, I mean, this is the most important thing these days, and this is the thing that is moving the most. So the US 10 years year to date is up 40 bips, so 0.4% from roughly 0.9% at the end of December 2020 to 1.3% and above these days. There has been quite a big move over the last 5 days or week, not only in the US, but across the world. So the Bund, the BTPs, same with the gilt. So yields are going up, bonds are selling off. So that is impacting currencies, and that is maybe that's going to start to impact equities as well. In terms of the VIX, the implied volatility for the S&P 500, so now we are around 24%. Now, yesterday we were at 21%, and we touched below 20%. You need to keep in mind that historically the VIX is around 19% on average. We are living in a world where the implied volatility is higher than usual, because there are more uncertainties, but as well because the 500 stocks that are making the S&P 500 some of them are moving quite a lot and are impacted massively by the players, the retailers, all these strong action, price action that people do with buying calls. So that is disturbing, or let's say impacting the normal implied volatility. I strongly advise you to look at implied volatility versus realized volatility to get a better picture. In terms of winners versus losers, so the winners, as usual, these days, we get a lot of SPACs that are making the headlines. Clearly, this market, 5 to 20% of all those stocks are moving big time. So instead of having the big names like Amazon, Apple, and the FANG, now a lot of attention is going for those names. And SPACs has been really on fire since September. I think there was something like 80 to 100 billion raised in January. So you can decide which way you look at it. I think there are many bubbly stories over there. The problem with a bubble is it's always hard to pick the top, but be careful if you're trading it, because those things are moving with actually 90% of the time that the fundamentals are very doubtful. Top losers, some names, some earnings some earnings and some news on biotech. Next one, the calendar. So as always, we try to look at what are the next catalysts. So today we have Yellen that is talking at the close, but more importantly, tomorrow we get the flash PMIs across the world. So that's going to give us another picture of what might happen in the next few months. Other than that, for next week, there is not that many data to expect. The only interesting is the fiscal stimulus that probably going to come at the end of this month, between the 25th and the end of the month. So that is another catalyst. This is the market is looking for these other catalysts. In terms of earnings, because the earnings season is not over, on Monday we get some names that I find interesting, like Ingersoll. We get Diamondback. On Tuesday we get Home Depot. Wednesday, NVIDIA and Viacom. Thursday, Monster and Salesforce. More importantly, tomorrow we get the expiry of the options. So for those of you who have been following me, I've been a bit boring at repeating myself with the options, but looking at expiry is always important. And this expiry tomorrow, there is a lot of open interest. Why? Because from January, there have been a lot of call buyers in the market. So there is a lot of gamma, delta position, you name it, that are supposed to be, and that will be closing tomorrow. So that might bring more volatility, and as well, you can make sure that tomorrow there's going to be a lot of volatility and volume. So again, tomorrow, expiry, next week, fiscal stimulus, and as well the market. What about we go into the, if I find it, yes, the price action. So let's start with the one that we just mentioned, which is the volatility with the VIX. So the VIX has traded below 20, but I mean, don't do technical analysis on the VIX. It's just that to give you a bit of feel of what is the implied volatility versus history. So this is the story these days. I think the most interesting chart in technical these days is the S&P futures, which has been pretty nice to trade. So it has been trending and struggling. I mean, struggling is a big one because it's going up. But technically, so yesterday we had, 2 days ago, we had 39.60 as a good level. So really, this is the trend, which is quite easy to trade. So if you want to go and trade it short, this is a nice way to put your stop loss. What about we look at the NASDAQ? So the NASDAQ today is selling off. Again, the chart so far is perfectly fine. It's just that it's going up and up and up. This is not so bad. Philadelphia Stocks Index, same story. It's the same like the South Korean index. Those are the indexes that you should be looking at if you think that there's going to be rotation and that the market could be suffering. Russell, I mean, this is something that I've been tweeting on and mentioning since the move from the Trump and the vaccine. So now we had a bit of consolidation, but you can see that since the breakout, we have been up 500 points, which is roughly 30 to 40%. So that's a big move. That tells you that there has been rotation in the market. So if we look at SPY-G versus SPY-V, so if we look at growth versus value, this is less obvious. Okay, so there is consolidation here if we only look at the S&P 500. But what is really interesting is if you look at last week S&P SPY volume, that was very low. So actually the SPY volume, I think it was Monday, 10 days ago. I can't remember exactly when. So check the SPY volume. The volumes were extremely low, whereas NASDAQ and some other shares were trading big. So some investors are chasing more and more risky stories to make some returns. And that means as well, there is some rotation. Is it only trading rotation? But clearly there is pocket of this market that is quite that move a bit too much. We are going into Europe here. Here we are looking at the Stock 600 banks futures. So that's something again that I've been looking for years and years because I've been trading Europe as well. So we broke out this 115 level. The banks have been doing better in Europe based on a bit of steepening of the yield curve, very small. But that tells you about the risk on in the market. US 10 years, moving from one asset to another. So government bond yields, now we are at 128. The next target is 150. Again, the move are based on the reflation trade and the expectations that the economy is going to be doing better. So we need to check if it's going to have impact on the equity market and as well which sectors will benefit from it. Historically, by definition, the banks are doing well, utilities are struggling. If you look at the 10 versus the 2, the steepening of the yield curve, so the 2 years is staying at the same level because the Fed is controlling the short end of the curve, but the 10 years is actually moving big. So there is a steepening of the yield curve. This is the one. No, this is the one, sorry. So you can see how quickly the move has been done for the yield curve. We're going to be looking at the Fed expectations later with the euro dollar. In terms of commodities, let's look at the oil futures, again, 60, 62. So that is extremely, I mean, that is very impressive. I'm quite, again, I was not expecting oil to go that high. Now I think the big level at 65, but clearly, the oil and commodities, most commodities have been doing much better than I mean, gold futures is a bit of a dog. So that is an important level for the people that are still long the gold. So 1760 is really a strong level. If we go below, then use your stop because I'm not sure that it's going to be bouncing quickly. Copper, I think copper is overextended now. I liked it before. I think it's too much. That doesn't mean that I'm going to go short, but watch out those spaces that have been extremely strong, those commodities. We are up 15% almost year to date, and we have been moving like crazy since the bottom in March. So be careful on that space. I think for the currencies, as I've been saying, I've been moving sideways, so I don't want to be spending too much time. I still get a dollar sterling target at 140. I think the euro dollar should be consolidating up to 117, 118. Okay, so let's go back into the calendar and going into the next slide, which is the central banks. And here I'm looking at the euro-dollar future. So for those of you who don't know what it is and who haven't done, unfortunately, the 4x4 video series or the mentoring, the euro-dollar is a good way to understand how and what is the market pricing for the Fed expectations. So on the top end, we have the expectation that we had, sorry, that's a bit like a kid doing some drawing. That's the expectations from the euro-dollar future when we did the last webinars 2 weeks ago. And at the bottom, this is from a couple of days ago. What you can see is these from September to March. More importantly, the March 23 has been moving down. So now the market is pricing the Fed to hike rates in December 23, which was actually 2 months ago. We were expecting nothing before, I think it was June or September 2024. So expectations are coming earlier. Why? Because again, inflation is going up, and that is making the euro-dollar moving and the Fed expectations moving. In terms of central bank balance sheet, this is, as you know, something that I'm checking, and I will always need to remind people. Those are some of the forces that you have in the market, which is the Fed balance sheet and the ECB balance sheet. The speed is not as strong as it was during the first 3 months of the pandemic, but this is still a very strong QE or quantitative easing. So there is still a lot of liquidity of help from the central banks into the system. So that's something to consider when we look at risk on, risk off. First topic of today, that's the earnings season. So this one is from a FactSet. When I do the mentoring, I always strongly advise my mentees to subscribe to the FactSet emails list. They do have weekly blogs, which are interesting, especially when we do the earnings season. And here, this is the picture for the S&P 500, where they clearly underline that 74% of the companies in the S&P 500 have reported better than expectations. And of these companies, 80% have reported actual EPS above estimates. So that means we are in a very high good earnings season. So this is a very strong earnings season. As you can tell from those 11 sectors, communication services have been extremely strong, in technology as well. On the other hand, we got real estate and energy that have been, and utilities that have been not that strong. But the overall picture is really this earnings season have been extremely strong. Actually, sorry, so this is for the S&P 500, but actually this is even more true for the stocks from the Russell 2000. So can't remember where I read that. The Russell 2000, the beat was more than that. And instead of beating by 10% for the earnings, I think that the beat was 20 or 30%. So like a huge beat from Russell 2000 companies. So here we got the picture on the, so this is from Barclays, looking at what has been beating. As we can see, again, this is the communication services that has been leading the pack. Utilities, not that great, but overall, the beat has been 81%, which again is way above the average beat. And the EPS surprise have been 15%, as I said. For the Russell 2000, it was, I think it is 30%. So massive beat. That is always interesting to look at which sectors, which industry have been doing better. And as well, as I discussed with one of my mentees a couple of days ago, when you do your filtering, so if you look at a company and say, oh, this company is going to go by 15%, yes, that is important, but you need to compare this company versus the S&P or the benchmark versus the sector and versus its industry. So if one company has got a 15% earnings growth for this year expectations, but the overall sector is expected to grow by 30%, that tells you what? That tells you that actually this is probably not the best in terms of alpha generation. Here I'm looking at the SXXP, which is for the stock 600 and the S&P 500, not only because I'm European, but I think this is important for you to be trading not only the US and think about, you know, diversifying as much as possible if needed. As we can see, again, and as usual, I should say, the S&P is outperforming, the S&P companies are outperforming the stock 600 companies. More importantly, that is this one that is very important, is the beat from the EPS from the SXP is maybe 18%, but, and there is a big but, the sales have been below the expectations. My conviction is always the same. In the long run, if the sales are not good enough, it's going to be hard to have good EPS. So that means the quality of the S&P beat has been very good because both the top line and the bottom line have been beating. But for Europe, the beat is mainly coming from the bottom line and not from the sales. So that is Europe has an issue, and they missed on sales. Earnings season here, this is for the stock 600. Tech have been pretty strong, as we can see. That's so the tech story is not a US only story. It's a world story. Tech has been outperforming the market and the economy overall. Healthcare has been strong. On the other hand, we got financials that have been pretty bad. Having said that, as I told you before, there has been some breakout on the stocks 600 banks. I strongly advise you to follow Santander, for instance, which is a good leading indicator these days of how the sector is doing. Now I want to move into the second topic of this webinar, which is the passive flows. So at the start of this month and end of January, we had a massive inflows from passive investment. So to check passive investment, to check the flows, you can go into ETF.com, and they're going to give you what have been the top 10 creations and top 10 redemptions. But as well, what is nice is you can be checking for any single ETF how have been the flows from one period to another. So as you can see, from the 5th to the 11th, SPY, both with IVV and the SPY, S&P, have collected around 12 to 15 billion. So there has been a strong inflows that started actually a bit before. So if we look at before, so here those are data that are collected on Bloomberg. So over the last 2 weeks before this call, we had roughly 50 billion going into equities. That is just huge, huge, huge. If you have inflows coming into the market, by definition, as money is pouring in, there is a good chance that assets will go up. So if we look at the fixed income, it's not that big. So really the money is pouring into equities. Again, 50 billion, I think year to date, we are talking about between 80 to 100 billion, which is pretty big. So let's carry on with the passive flows. What is as well interesting is over the last 2 weeks of the start of February, even Equity International was pretty strong. Not as strong as the US domestic, but 15 billion is a big number. So we had roughly 35 billion for equity domestic, 15 billion for Equity International. So that helped Europe going higher. So the flows have been, until a week ago, extremely, extremely strong. I like to be looking at these passive flows. Here, this is a chart from someone that I found on Twitter. So this is his name here, where it's giving us the flows that we have in January versus a normal year. And you can see how big the inflows are. So there is a combination here these days of central banks still in town and pretty active. We got earnings season, which is very good. Earnings flows that have been extremely strong. So inflows, data, economic data that have been very strong. So retail sales yesterday were incredibly strong. The new building permits today were extremely strong. So the risk now is to have a bit of overheating. So when everything is nice and you think, okay, I should be buying with both hands, actually be careful, because the market has been moving quite a lot. We have all been chasing many names. And I think now you need to be careful and checking what is the bond market telling you. The bond market is telling you that there is a risk of inflation coming sooner than expected. Even if the Fed wants to run this market like a hot potato, with a hot potato, be careful, because it can burn. What might help these days is, with implied volatility coming a bit lower, it's less expensive to do some hedging than it was before. So it's still expensive versus history, because we are 20% plus, but those are probably the things that we should be doing. There are, again, many spaces of the market that are quite extended. That doesn't mean that they're going to go higher. The flows, check those flows. Next one is similar idea. So this is the flows that we had in Europe. As you can see, we had in January an historical high for inflows across the world. So passive investment is really disturbing the market. Disturbing, I don't know if that's the right word, distorting the market. So in terms of passive flow here, I give you an example. I think this is one of those crazy stories, where here we are looking at POT, which is the ETF for cannabis. And here we get the number of shares of the pot. And as you can see, the chart is just going parabolic. And that tells you what? As I read yesterday, one of my mentees was saying, and which is very true, there is now an ETF for everything. And that means as well, you're going to see money pouring into some places, and passive investment means they need to be buying shares. When they need to be buying shares, so here this is the chart of TIRA or TIRA, that is the correlation with the previous ETF is pretty stunning. Again, to do ID generation, I think the size of the passive investment is getting bigger and bigger. So there was 10 days ago or last week, a nice video done by, I think I tweeted on that, nice video explaining the market structure. And the market is more and more driven by two things, which is options and passive investment. So always check, when you look at a position, when you look at a stock, if this stock is in one or two or several ETF, and what is the weighting in this ETF. As well, you need to have an understanding of what are the inflows and the outflows, because as we have been saying and seeing at the start of February and the end of January, market was extremely strong on those inflows. That tells you that you're going to be impacted, but as well, as we covered, I think it was a month ago, that brings some good opportunities. So GME was a really good opportunity, where if you wanted to trade GME short, that was impossible, but you could have exposure short through GME by shorting some of those ETF. I'm not telling you to necessarily to go short those stories, but what I'm telling you is look at passive investments. Try to understand ETF. Again, they are making 30 to 50% of the daily volume. If you don't get the basics, like you don't get the basics of options, that's going to be you might be struggling. Quickly, as I discussed before, so pretty excited to have the community. I'm looking forward to all my mentees and all the subscribers of the 4x4 to join and bringing ideas. The 4x4 video series, so that's something that I launched in October 2019. And that is a comprehensive online video course where you're going to get 40 videos plus 30 hours of footage, 50 Excel spreadsheets to build your ID generation, where the ID generation is based on top-down, bottom-up special situation and active trading. I know that some of you have been struggling with other education, and I know those education are trying to change the story now, but clearly, if you do top-down, bottom-up special situation active trading, and you should be able to find better catalysts if you haven't done, and if you're struggling with fundamental analysis, the video series will help you massively as well, looking at options, looking at your risk management. On top of the video series, we and I still do the mentoring program. This is something that I really enjoy. I'm benefiting from their ideas. I'm benefiting from sharing ideas. So this is a nice thing to do. This is a combination with the 4x4, but not only. So if you get questions, if you think you're interested in doing the mentoring, I'm happy to have a call with you. This is a 12 weekly one-on-one online sessions, similar as the 4x4. I'm helping you to build your infrastructure. We do a lot now into Reuters Metastock because I have a lot of infrastructure to share with you. I changed recently the way of doing the mentoring with Metastock because I think it increases and it speeds up the process. Similar, we'll be looking at top-down, bottom-up, active trading and special situation across asset classes. I think that works pretty well. It works for people who want to be managing their own money or people who want to have access to the industry and are trying to build their track record. So if you got any questions, you can send me an email at greg@duponttrading.com. For the subscribers and again the mentees, I hope to send you in the next few days an email on how to get access to the community. I'm very excited. Again, I think people have been really not dying, but really want to have access to this community. I used to be working in this industry for another provider. I think that is important to give to you retail traders access to a clear community and not to tell people, you can go and share ideas on WhatsApp. So hopefully we're going to do something nice with it. Again, pretty excited. What about I do a bit of questions because today, maybe I got a bit of time. I got a question from Andrew. Been looking at commodities. How would you approach to detect if there is a super cycle? Super cycle. So that was the talk of the end of last year and the start of this year. The super cycle, you need to keep in mind that the super cycle ended up the previous one in 2012, 2013 because China was slowing a bit. So there are, with the super cycle, I think it's more a question of some part of the commodities will benefit more than others. Okay, so if we look at copper, if we look at nickel, if we look at clean energy, there is a trend, and you can't be, there's going to be hiccups, there's going to be reversion to the mean, but the trend is there. So look at those long trends that's going to be there for the next 15, 20 years. similar to what I did. So if you look at the presentation that I did in January 2020, I think uranium will be benefiting in the next 20, 30 years because, nuclear, we need more nuclear. If we want to have clean energy, nuclear is probably a good proposition. Question from Colin. Sometimes it's difficult to acquire the more specific data like reliable N2 data. My answer, Colin, if you want to have the good data, you should be definitely looking at the 4x4 video series. You're going to have all the data that will be needed to build your infrastructure. This is really something that I offer. I don't tell people you should pay another X dollars to get access for the data on a yearly basis, because I give you all the tools and all the sources to get them. So literally, when you do the 4x4, then there is a bit of time updating the data. But if you're not committed to do it, then it's going to be hard to be making money. So yes. I got a question from Edward. First question was about Madoff. Madoff was Madoff. If you want to ask, maybe one day I should do a webinar with talking about Madoff and bringing some ex-colleagues talking about what happened there. Reversion to the mean. So we are looking at Turkish lira, and we are looking at the stimulus package. I think the stimulus package a lot is pricing. So is it going to be weakening the US dollar? You can argue that across the world, everyone is doing fiscal stimulus. So everyone is saying, sorry for my English, fuck it, let's print some money and we'll see later. I think this is important to start the economies very quickly, and that makes sense to have those fiscal stimulus. I still believe that the carry trade and the widening of the carry trade, let's say, is helping the dollar and should be helping the dollar. As I said, at 123 with against the euro, I was a bit struggling. Having said that, my target short term is midterm is 117, 118, so we are in between. Kirandip, send me an email for Reuters Metastock. I have a deal with them. So that would be Reuters Icon, and I can give you which one I recommend. Ingo, nice to meet you. Looking forward to the community. I've been looking at long TIP and short TLT to capture some of the looming inflation. Long TIP, short TLT. I mean, that makes sense on paper. I don't know by how much it has. I haven't checked recently by how much it has been moving. What I was saying, and I've been saying for the last 3 to 6 months, I think the good trade was looking at the 2023 and the 2024 euro dollar. And I've been on record, both during the webinar last summer, looking at put on the euro dollar on the that was 2024. It works, and it's still working very well. Those are the places literally where the market was saying 3 months ago, oh, the Fed is not going to do anything. They are not going to change anything. So nothing was priced until end of 2024. So that was a free call. Your downside was pretty much nothing, and your upside is really a lot of inflation and the Fed being late in the move, and might move very quickly. So as you can see, again, Ingo, you've done the 4x4. Check the euro dollar curve. I think this is something that's going to help you. Long TIP and short TLT can be if you have a chart, if you have a risk reward, send it to me. I'll have a look, because I think that might be very interesting. For Edward, looking at Santander as a leading indicator, yeah, because I think that if you look at the breakout of the stocks 600 banks, before that, Santander started to move up. So I'm always trying to find some leading indicators, some stocks in the sector, in this industry that are leading, and where you can see the move before. And similarly, that means when those things start to turn, that tells you that there is rotation in the market. So as we discussed since September, we know that the FANG have been rotating a bit. If you look at Amazon, Amazon has been consolidating for months now. So this is a huge consolidation. If it breaks, obviously, it's going to be moving big time. But those are the things that you should be trying to identify. Always these days, what are the leaders? On one hand, you get the semiconductor, so you'll be looking at the KOSPI with the Korean index, and you'll be looking at the Philadelphia SOX index, which tells you a lot about, this leading indicator, but it's mainly based on the fact that auto sector has been restarting much quicker than before. So there is a lot of demand for chips. If you look at the other part of leading indicators, you obviously, what has been working well is financials based on the steepening of the yield curve, and WTI/XLE performing well. Otherwise, if you go incrementally into the market, there is a lot of dodgy stories that have been performing well. And when I say dodgy, we are talking SPACs, we are talking GMEs, we are talking the names that have been pushed by all those guys on Twitter, where there is no or very little fundamentals. And now, actually, as you can, the last few days, the new game in play is to edit and publish the ARK position. So ARK is running a 30 billion plus, and they have been doing very, very well. Okay, so they have been outperforming anyone. When Tesla was 50% lower, they say it's going to keep on going. So they have been very right. But you start to see a bit of turn in these stories. Why? Because people are more and more chasing risky stories for less and less returns. So when you come into a market where you trade the plug, where you trade the EMC, you trade the GMEs, where you trade the SPACs, that means everyone is chasing the same. And when I say everyone, is the retail world. So far, so good. If it turns, and it's gonna turn, it's gonna be pretty ugly. Anything else? I think I've covered what I wanted to cover. So again, for the subscribers, for the mentees, try to jump on the community. That is a good story. You can't complain now about not having a community. There is something. I hope that will help you, that will help us with our ID generation and our trading. If you get any question, you send me an email. If you get questions about the 4x4 or the mentoring, I'm pretty easy and very happy to have a call with you. Thank you very much, all of you. And I will try to do now every 2 weeks these webinars. Thank you. Have a good weekend, and have a good day tomorrow with the expiry of the options. All the best. Bye-bye.